Someone bought a house in Austin, Texas in the spring of 2022. They paid $570,000. They put 20% down. They signed a 30-year mortgage. They were told, by their agent, by the internet, by everyone around them, that this was the smart thing to do. That real estate only goes up. That they were getting in just in time. In the first quarter of 2026, that house is worth $426,000. They are underwater. And here is what makes this story unusual. It is not unusual at all. Across the United States right now, in 5 specific cities, some of them places you would never expect, the housing market is not softening. It is not correcting. It is collapsing in slow motion. Prices are falling. Inventory is swelling. Homes are sitting on the market for months, and the people who own property in these places are beginning to understand something that the headlines have not fully caught up to yet. This is the story of 5 cities where that bill is now coming due. And what happens in these places over the next 18 months will determine what happens to the American housing market for the next decade. To understand what is happening in these cities, you have to understand what happened to the American housing market between 2020 and 2022. Between those 2 years, home values surged by nearly 40% nationally. Mortgage rates were at historic lows, below 3% in many cases, and the combination of cheap money, a remote work revolution, and a desperate shortage of inventory created conditions that had never existed before in the modern era. People were buying houses they had never seen in person. They were waiving inspections. They were paying $100,000 over asking price. It felt like gravity had been suspended, but gravity was not suspended. It was just delayed. Here is the mechanics of what is now unfolding. The mortgage lock-in effect, the phenomenon where homeowners refuse to sell because they are trapped in 2 and 3% mortgage rates, has kept inventory artificially low in most of the country. But in the cities we are about to examine, something different happened. Builders overbuilt, investors over-leveraged, remote workers moved in and then moved back out, and the supply has piled up faster than demand can absorb it. J.P. Morgan Global Research has put it plainly. They expect U.S. home prices to stall at 0% growth nationally in 2026. But 0% is the average. The cities doing the heavy lifting on the downside are doing considerably worse than 0. 43 of America's 53 largest metro areas are now carrying more than 7 months of housing supply, the threshold that officially signals a buyer's market. In 8 out of 10 major American cities, the buyer now has the upper hand. That is a structural reversal that would have seemed impossible 3 years ago. Insurance costs are making it worse. In coastal and storm-prone markets, homeowners' insurance premiums have risen so dramatically that the true monthly cost of owning a home has increased even in neighborhoods where the list price has actually fallen. You can buy cheaper and somehow still afford less. These are the conditions. Now here are the places. If there was one city that embodied the pandemic housing frenzy, it was Austin. Tech workers flooded in from San Francisco and Seattle. Tesla moved its headquarters there. Oracle followed. Between 2020 and 2022, Austin home prices appreciated by somewhere between 50 and 60%, roughly double the already extraordinary national average. The city became a symbol. Writers called it the next Silicon Valley. Realtors called it recession-proof. Everyone called it the future. Then came the correction, and then came the correction to the correction. As of March 2026, the median sales price for the Austin Metro stands at $426,000. That is a 3% drop from 1 year ago. But 1 year ago was itself lower than the year before that. From its 2022 peak, Austin has now fallen 18 to 20%. In dollar terms, that is more than $100,000 in lost value for a median home. Inventory tells the same story in reverse. Active listings in the Austin Metro reached 33,751 in the first quarter of 2026, a 4.5% increase from the same period the prior year. Homes are sitting on the market an average of 85 days. The average sale price is now 92.8% of the asking price. 2 years ago, homes were regularly selling at 105% of list. The overbuilding is the core issue. When the remote work migration wave arrived, builders responded. Cranes appeared across the skyline. New subdivisions expanded out into the hill country. Supply ran ahead of demand. And when some of those pandemic migrants the ones who discovered they missed their friends, their families, their original cities, began trickling back, the supply stayed while the demand left. There is a second force compounding the problem, and it rarely makes the headlines. Texas has no state income tax, which historically made it attractive to high earners relocating from California. But Texas property taxes are among the highest in the nation, and homeowners insurance premiums in Texas have seen some of the steepest increases in the country, driven by storm exposure. The monthly cost of owning a home in Austin has climbed even as the purchase price has fallen. The math stopped working. The prognosis is sobering. Most mainstream analysts expect additional modest price softening of 1 to 3% through mid-2026. Some pessimistic forecasts project continued decline through 2028. The bottom has not yet been found. And Austin is not alone in Texas. San Antonio prices dropped nearly 2% year over year at the end of 2025. Dallas saw meaningful downward pressure. The entire state of Texas recorded a statewide decline in home sales of 8% year over year heading into 2026. But what is happening in the next city on this list makes Austin look like a minor inconvenience. Cape Coral sits on the southwest Gulf Coast of Florida. It has more navigable waterways than any other city in the world, more than 400 miles of canals running through residential neighborhoods, most of them with direct access to open water. For a certain kind of buyer, a certain vision of retirement, a certain dream of warm winters and water views, Cape Coral was the destination. Between 2020 and 2022, it became one of the hottest real estate markets in the country. Prices surged. Investors poured in. Remote workers arrived from the Northeast and Midwest. The Wall Street Journal at one point named it one of the best housing markets in America. 5 years later, the same publication would call it the worst. What is happening in Cape Coral is not just a housing story, it is an insurance story. And it is a climate story, and they are all the same story. Cape Coral has the third highest insurance premium to market value ratio in the nation. On a $350,000 home, a homeowner can expect to pay more than $7,700 annually in insurance alone, before a single mortgage payment, before property taxes, before HOA fees. The Gulf Coast location that made the canals so appealing is also what makes the risk uninsurable at a reasonable cost. After Hurricane Ian devastated the region in 2022, the insurance market for coastal Florida effectively fractured. National carriers withdrew. State-backed insurers of last resort absorbed an unsustainable volume. Premiums spiked, and buyers began to do the actual math, not the mortgage payment math, but the total cost of ownership math. And many of them walked away. The foreclosure picture is equally grim. ATTOM data from late 2025 showed Cape Coral carrying one of the highest foreclosure rates among major metro areas in the country. Investors who bought at the peak, expecting continued appreciation, are now exiting at a loss or defaulting entirely. Their listings flood a market that is already oversupplied. Meanwhile, inventory sits between 6 and 9 months of supply, deep into buyer's market territory. Homes are taking a median of 57 days to go pending. The pace of decline has not slowed. Here is what nobody is fully accounting for yet. The long-term demand profile for Gulf Coast Florida is changing. Domestic migration to Florida has cooled from a surge rate of 3.5% in 2022 to just 0.5% in 2024. The people who were going to move to Cape Coral, many of them already moved. The wave has passed. Researchers at Catality have assigned Cape Coral, along with Northport, Lakeland, St. Petersburg, and West Palm Beach, the designation of very high risk for continued price decline. 7 of the top 10 coolest housing markets in the entire country are located in Florida. This is not a Cape Coral problem. This is a Florida problem, and it will not be resolved quickly. Phoenix was the success story everyone pointed to. Sprawling, affordable, sunny, business-friendly. During the pandemic years, it absorbed an enormous influx of migrants fleeing high-cost California markets. Home prices shot upward. Construction cranes dominated the skyline. Phoenix seemed to prove that the Sun Belt could absorb unlimited growth. But there is a pattern that repeats itself in every major housing correction. The cities that rise fastest in a boom always carry the most concentrated risk when the tide turns. Phoenix rose very fast. Realtor.com projected Phoenix home prices would fall 2.3% in 2026. That is the forecast. But here is the question. When a market that inflated 50% over 2 years starts pulling back, does it stop at 2.3%? Or is that number the floor, not the ceiling? The Greater Phoenix median sales price sat at $458,000 as of early 2026, down from pandemic-era highs and still falling in some submarkets. Inventory is approaching 8 months of supply. Along with Austin and Tampa, Phoenix is among the most oversupplied major markets in the country by the metric of how long it would take to sell every listed home at the current pace of transactions. The overbuilding problem is acute. During the pandemic construction boom, developers in Phoenix and the surrounding valley built aggressively. They were responding to genuine demand, but demand that was partially artificial, inflated by sub-3% mortgage rates and a work-from-anywhere economy that turned out to be neither permanent nor universal. When corporate return-to-office mandates arrived, and when mortgage rates climbed above 6%, some of that relocated population started reconsidering. The structural lock-in effect that is protecting markets like New York and Chicago, where longtime homeowners refuse to sell their low-rate mortgages, provides less protection in Phoenix, because Phoenix attracted a disproportionate share of relatively recent buyers, many of whom purchased at or near the peak. They do not have decades of equity cushion. They are not sitting on a 2.5% rate from 2019. They bought in 2021 or 2022, and they are watching values drift below their purchase price. There is one force that may arrest the decline. Phoenix is the site of a massive TSMC semiconductor manufacturing investment, billions of dollars in new industrial capacity, creating thousands of skilled jobs. If that employment base materializes as projected, it could provide a demand floor. But job creation is measured in years, and housing market corrections can move faster than construction timelines. The consensus among analysts who watch Phoenix closely is this: the market is not crashing, but it is not stabilizing either. It is searching for a bottom, and it has not found one yet. Boise was supposed to be different, small, affordable by comparison, connected to nature, a genuine quality of life story rather than a speculative bubble. When remote workers started looking beyond the coasts during the pandemic, Boise topped every most livable list. It became, briefly, one of the fastest appreciating real estate markets in the country. And that is exactly the problem. Boise's story is actually the template for a dozen smaller American cities, places like Spokane, Tucson, Memphis, that became beneficiaries of pandemic migration, saw prices spike far beyond what local incomes could sustainably support, and are now experiencing the arithmetic correction of that spike. The story is not unique to Boise. Boise just happens to illustrate it most clearly. Realtor.com projected Boise home prices would fall 0.8% in 2026, a modest number on its own, but it arrives after years of extraordinary appreciation that left median prices in the $470,000 to $500,000 range for a mid-sized city in Idaho. Idaho remains one of the most unaffordable housing markets for middle-income buyers in the country. That is not a sentence that would have made sense 10 years ago. The inventory surge has been particularly stark. In some market segments, active listings rose 80 to 120% year over year at points in 2025. Foreclosure filings in Idaho rose more than 94% year over year in October 2025. A sharp increase from a low base, but a direction that warrants attention. What is more difficult to quantify is the psychological shift that is underway in Boise's housing market. During the boom years, there was genuine competition, multiple offers, rapid decisions, buyers who drove 12 hours from California to tour houses they found on Zillow. That energy has dissipated. Homes are sitting. Sellers who priced based on 2022 comps are watching their listings age. The saving grace for Boise is its economic diversification. Micron Technology has invested $15 billion in a chip manufacturing expansion nearby. Meta has committed $800 million to a data center. These are not speculative promises. They represent real employment anchors, but they are long-term stabilizers, not short-term catalysts. For the next 12 to 18 months, Boise sits in an uncomfortable middle position. Too expensive for local buyers, not expensive enough to attract the highest earner remote workers who drove the original surge. Until that gap closes through wage growth, price decline, or rate reduction, the market will remain under pressure. Tampa was named one of the 5 U.S. housing markets most at risk of price decline by CoreLogic researchers. It was flagged, specifically and by name, as carrying a greater than 70% probability of price decrease in their 2025 projections. That projection has since been validated. Tampa's problems are a concentrated version of what is afflicting all of Florida, combined with a set of additional risks that are specific to its geography and market structure. Like Cape Coral, Tampa sits on the Gulf Coast in hurricane territory, with rapidly escalating insurance costs. HOA fees in many Tampa area developments, the dense, amenity-rich communities that attracted so many retirees and younger buyers, have risen sharply, in some cases doubling over 2 to 3 years. When you add insurance, HOA fees, and property taxes together, the carrying costs of a Tampa home have become genuinely punishing. Consider what this means for a specific buyer. A Tampa home purchased in 2022 at the median price with a 6% down payment might now carry a monthly cost, mortgage, insurance, taxes, HOA, that is $400 to $500 higher than it was at purchase, even though the purchase price has not increased. In some cases, the cost has risen while the value has fallen. This is not an abstraction. It is a lived financial reality for tens of thousands of Tampa homeowners. The new construction issue in Tampa mirrors Phoenix and Austin. The pandemic boom triggered a surge in apartment and condo development that is now producing completed units into a market where demand has softened. Condo and townhouse sales in Florida fell 6.4% year over year in mid-2025. The condo oversupply in the Tampa market is particularly pronounced. Tampa's inventory has climbed toward 8 months of supply. The same Fortune analysis that flagged Cape Coral as the worst performing major market in the country placed Tampa, Austin, and Houston in the same category of most swamped by supply, relative to buyer demand. There is one additional variable that the data cannot fully capture yet: the psychological effect of watching the Florida insurance market continue to deteriorate. Every major storm that makes landfall in the Gulf, every carrier that withdraws from the Florida market, every renewal letter with a premium increase, these are signals that reach potential buyers before they ever look at a listing. The demand destruction happening in Tampa is not purely economic. It is partly driven by the calculation that the lifestyle has become too precarious to justify the price. What has been described so far is the current state of the market. But the current state of the market is not a static condition. There are forces building underneath these numbers that have not yet fully expressed themselves in prices. For the past 3 years, the mortgage lock-in effect has suppressed inventory in most of the country. Homeowners sitting on 2 and 3% mortgage rates have refused to sell, but that condition has a natural lifespan. Divorces happen, estates get settled, job relocations become unavoidable. As time passes, more and more of those locked-in homeowners will enter the market whether they want to or not. When that inventory arrives, it will arrive into markets where buyer demand is already suppressed by affordability constraints. The homeowners insurance crisis in Florida, Texas, and other coastal and storm-prone states is not stabilizing. It is escalating. New listings are arriving in the market with insurance disclosures that are alarming buyers who have done their research. The true monthly cost of ownership in these markets is increasingly divorced from what the listing price implies. This gap between what a home appears to cost and what it actually costs to own is not yet fully priced in. This is the variable that almost no housing analysis is incorporating, because its timing is too uncertain to model. But the conversations happening inside technology and finance companies in early 2026 are about workforce reduction enabled by AI tools, not the speculative AI job displacement of future years, the actual current displacement of knowledge workers whose tasks are being absorbed by software. If those layoffs materialize at scale, they will hit the very demographic that supported the pandemic housing surge: younger, high-income, mobile professionals who bought homes in places like Austin, Boise, and Tampa, believing their earnings were secure. Foreclosures operate on a delay. A borrower who defaults today may not appear as a distressed sale for 12 to 18 months. The rising foreclosure filings visible in the data right now, up 19% nationally year over year as of late 2025, up nearly 100% in Idaho, represent future inventory that the market has not yet absorbed. That inventory is coming. The American Enterprise Institute, one of the most closely watched sources on housing data, was projecting in April 2026 that the year-over-year national price trend would go negative within weeks. Not in the struggling Sunbelt markets, nationally. That is the first negative national reading since the data series began tracking in 2012. Here is what this is not. This is not 2008. The lending standards that created the subprime crisis, the no documentation loans, the stated income mortgages, the financial instruments designed to obscure risk, those were eliminated after the last crash and have not returned. Most homeowners in these 5 cities have genuine equity and legitimate income. The foreclosure wave, if it comes, will not resemble the tsunami of 2008 through 2011. But here is what this is. This is a structural correction in markets that ran too hot, too fast, based on conditions, near zero interest rates, unlimited remote work flexibility, a once-in-a-generation migration shock that were never going to be permanent. The cities that benefited most from those temporary conditions are now recalibrating. Some of that recalibration will be orderly. Some of it will not. The people who bought in Austin at the peak of 2022 are not criminals. They were told the right things by people who believed the right things at a particular moment. The agents who sold those homes were not lying. They were extrapolating a trend that had been real until it suddenly wasn't. The question for 2026 and beyond is not whether these markets will recover. They will, eventually. Cities with strong employment bases and genuine quality of life do not disappear. Austin will rebuild. Phoenix will find its floor. Florida's sunlight does not go away. The question is how long the correction takes. How many underwater homeowners decide to sell before their equity returns. How much additional foreclosure inventory enters markets that are already oversupplied. Whether the insurance crisis in coastal markets resolves or deepens, whether the national price trend that has already gone flat goes decisively negative, and for how long. Those questions do not have answers yet. The data that will answer them is being written right now in the listings going live in Austin and Cape Coral, and Phoenix and Boise and Tampa, in the price reductions being posted by sellers who can no longer wait, in the foreclosure notices being filed in county courthouses from Idaho to Florida. The correction is not coming. It is already here.